So yeah, United Health Group Inc., UNH on the New York Stock Exchange. This is one of the largest private health insurers providing medical benefits. Along with its insurance, the company has its Optum franchises, which provide healthcare services from medical and pharmaceutical benefits to providing outpatient care and analytics. CVS Health Corp is pretty similar. CVS on the New York Stock Exchange. It offers traditional, voluntary, and consumer-directed health insurance products and related services, essentially benefits. And then they also have their sizable pharmacy operation, which includes nearly 9,900 retail pharmacy locations, primarily in the US. So I'm just going to kind of go slot for slot between each company, depending on what we're talking about. So UNH right now trades at a price of about $508 per share and has a $476.4 billion market cap. So it is a much larger business, whereas CVS trades at $97 approximately per share and has a market cap of about $128.5 billion. Now, UNH does pay a lower dividend yield of just 1.3% compared to CVS's yield of about 2.3%. And both of them had a payout ratio of 25% in the last quarter. That's just a coincidence. Looking at the long-term historical growth, this is a revenue growth rate. UNH had a compound annual growth rate of 9.3% from 2017 to 2021, whereas CVS's was about 12% over the same period. So CVS is growing top line revenue at a slightly better pace. And in the last quarter, net income was up 18.8% for UNH, where for CVS, it was only up 6%. Now, looking at the balance sheet, UNH has a much healthier balance sheet with net debt of about $23.4 billion and a net debt to EBITDA multiple of about 0.4 times. This is in comparison to CVS's net debt of about $59.2 billion and a net debt to EBITDA multiple of about 3.2 times. Looking forward for guidance, both provided full year GAAP EPS guidance for fiscal 2022. And looking at the year over year growth, this would, if they can hit their targets, this would equate to about 13% EPS growth for UNH, whereas CVS is guiding to about 24% growth over 2021. And quickly, just looking at the valuations, UNH has a forward PE multiple of about 25 times, where CVS's is 14 times. UNH has a 12 trailing month enterprise value to EBITDA multiple of 9.2 times, whereas CVS's is 10.4 times. And looking at the PEG ratio, or price earnings to growth ratio, this is essentially seeing if a company offers growth at a reasonable price. Essentially, UNH trades at 1.9 times, whereas CVS has a 0.6 times PEG ratio. So to conclude, both are quality businesses. CVS has historically grown revenue at a better rate, pays a better dividend yield, is guiding towards better earnings growth this year, has more attractive valuations in relation to growth. But the one negative of the company is that it is quite levered up. I would say that the debt is sustainable, but it is getting to the higher end of where we would like to see it. And then just keeping in mind, it is also a smaller company compared to UNH. Now, UNH, they have much less debt, but certainly trade at more of a premium given its earnings growth guidance. Personally speaking, I think that I would go with CVS given the better dividend yield and profile that closer fits growth at a reasonable price. But it's pretty close. It's tough. Especially looking at the debt load of CVS, the risk is definitely higher with that company. So yeah, it's a tough one. It is a tough one. But yeah, I'd like to open it up to Ryan, Aaron, and Brett and see if they agree with my analysis. Potentially
So
going
which
with
one
CVS.
would you buy?
I would go with CVS. That's what I would.
Okay.
They do have higher debt leverage. It is getting up to that 3 times net debt to EBITDA, which is getting to the upper range for sure where we would like to see it. But yeah, I think that it closer fits.
You have net debt to EBITDA of 3.2 times.
Or sorry, 3.2 times. Is that what I said? Around 3 times? Is that what I said? Yeah, 3.2 times. So it is
I mean,
getting to the upper
I
end.
don't think that's too bad. I mean, given they also have a retail element to their business as
Hmm.
well,
Yeah.
it's pretty capital intensive, so we'd expect some debt. I don't think that that's too bad. I mean, you're right 100%. The balance sheet on UNH is much better
Yeah.
in terms of just lower debt leverage. But I mean, I wouldn't say that CVS is out of line or speculative. Certainly, I wouldn't want to see the leverage go much more. I'd probably say
Hmm.
around 3 times. So maybe they're just would be more ideal. So maybe they're just above that. But as one of the things about UNH is I remember looking at them. They have a technology services element to their business as well. Do they not?
I'm not sure. Yeah, that would
Yeah,
be
that'd
news
be
to me.
something.
Yeah.
Yeah, need to refresh
Further
myself
dig.
on that.
Yeah.
But I don't know how significant it is in terms of contributing to the bottom line. So
Hmm.
I think just based off of the numbers, to really actually determine what company you would buy, we need to go much further in depth. But I think just based off of the numbers that you provided, the historical numbers, the valuation, I'd probably have to agree with you.
Hmm.
Um,
Well, thank you.
well, I
That
want
makes
to
me
I
feel
want to
good.
I want to review the technology segment of UNH as well, because I
Yeah.
remember thinking that was
Yep. No, that's a
potentially
good.
something
It's a
for the
good note
future. Mhm.
for sure.
Did you kind of faintly say that you agree with Brennan there?
That's what I heard.
I did not say
First
that. I
time
would
for
never
everything.
say
No,
that.
no. First time for everything, so that would
Of
be.
course, yes.
Um,
Sometimes I do agree with Brennan, right? Like I have a broken watch on my desk, and 2 times a
Mhm.
day it is correct. So,
Mhm.
2 times a day I
Sure.
agree with that
Mhm.
watch on the time.
Yeah.
So is he the broken one, or are you the broken one? What who's who
Brent,
here?
Brennan's the broken.
Okay, just making
No,
sure.
Brett.
now we're just harping on Brennan,
Oh,
which
Yeah.
Well,
is our favorite pastime here on
it's
Keystone
love.
Stock
It's
Talk
love.
podcast.
Yeah.
but on CVS, do you know if they're floating rate debt or are they
That would be
hedged
another
out?
good thing to look
Yeah.
into, of course, especially with rising rates.
Mm-hmm.
That'd be a
Yeah.
great thing to look into.
Most companies have a fairly small, like a smaller proportion of their debt variable
Mhm.
relative to fixed. But yeah, that'd definitely be something to
Yeah.
know. And as well is like when is it maturing, right? So if you have if you have some debt on your balance sheet that's fixed and it's maturing, in 5 years, well, it probably doesn't really matter what the
But if it's
interest
5
rate
days.
is. If it's 5 days or if it's a year, you got a
Mhm.
chunk of debt and you're going to have to renew it at a higher rate, and that can make a big difference for sure.
Yeah, for sure.